This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello, we're back from our summer break. Welcome to this week's episode of the AJ Bell Money and Markets podcast. And there is plenty to talk about, including a couple of rather big market wobbles amidst fears about the strength of the US economy and a slowing of Nvidia's AI growth story. With me this week is Laura Suter. Hi, Laura.
Hello, and as well as looking at all of that markets news, including some interesting takeover action from the Rupert Murdoch-owned REA Group's plot for UK property platform Rightmove, I'll be looking into the cut to cashback offers for current account switching as well.
Hot off the heels of Rightmove's takeover approach, Dan Coatsworth talks to one of its biggest shareholders, Nick Train, about the news and his thoughts on two other big-name FTSE 100 stocks.
And we've got plenty of pension action too, including how much the state pension is set to rise by next year. And Rachel Vahey, AJ Bell's head of public policy, is here with her latest pension corner.
But first, let's talk markets, because August, honestly, is usually the silly season, isn't it? But this year, it's not exactly been plain sailing. In fact, I've been stupidly busy. Starting at the beginning of the month, of course, we had an interest rate cut from the Bank of England. Laura, you can talk a bit more about that and what we might expect regarding interest rates over the rest of the year. But let's start with concern that maybe the Fed has been too slow to cut interest rates. We've had a couple of quite significant market wobbles. The first, as I say, took place at the beginning of August. In fact, that manic Monday, 5th of August, £41 billion was wiped off the value of the FTSE 100, although within a week it was back to normal, in fact, slightly above. And I was taking a look, and actually, in terms of since we had that market wobble at the beginning of August, the FTSE, the S&P, the Nasdaq, they are still slightly down on where they were. But looking at the full year, they're all significantly up on the start of the year. So the FTSE 100 still up 7%, the S&P 500 up almost 16%. So it just sort of goes to show that even though we've had these wobbles, it hasn't damaged some of the forward momentum that we've seen since the start of the year. But we've had another wobble this week, and it's all about the same thing. It is all about concern about the health of the US economy. So we've had jobs figures back in August, which started the ball rolling, coming in much softer than most people were expecting. We've got some fresh jobs data coming out at the end of the week, so stay poised for potentially more volatility then. But when traders came back to Wall Street after the long Labor Day weekend, they came back to fresh manufacturing data. And once again, it wasn't look particularly rosy. So we then saw another quite significant reversal of gains. The US markets down around 2%, followed on Asian markets, less volatile in the UK, but that might have more to do with the fact that we've seen some decent retail figures and also some decent PMI figures from the service sector here in the UK. But there's now a lot of concern that even though the expectation is that the Federal Reserve will cut interest rates on the 18th of September, and also expectation that maybe it won't just be 25 basis points, but 50 basis points, there's real worry that maybe they have just acted too slow and that the damage has already been done. We've seen a lot of indication that the consumer is a little weaker, particularly in those sort of lower earners. We saw McDonald's seeing a hit to its sales. We had Dollar Tree announcing that its sales had been softer and expected to be softer for the rest of the year. So all of that has impacted, and just a little bit of technical stuff to chuck in as well. There was a big issue with what's called the Japanese carry trade. This is a popular strategy in which investors borrow money at ultra low rates in Japan to deploy in other assets like US stocks. And a bit of a sort of roll off of that was occurring in August. As we heard from the European Central Bank saying that there was a likelihood that Japan's central bank would continue to raise interest rates. So that happened in August. And now there's more turbulence potentially expected as Japan is poised to sort of normalize after decades of deflation. So September is always typically quite a bad month, particularly for US markets. And even with the prospect of rate cuts, it looks like potentially it could be another dicey month.
And I think we should also talk about that tech sector and also the one stock in particular, which has been flying high thanks to all of that AI momentum that we've talked lots about before. But it seems now some of the hot air has been squeezed out of that.
Yeah, absolutely. We saw Nvidia down over 9% on Tuesday. That was a massive $279 billion drop in market value. And just to give you an indication, that is the deepest ever single day decline in market value for a US company. The last time that we saw something similar was back in February 2022 when there were all the concerns about the Facebook owner Meta. And that day it saw 232 billion wiped off its value. So you can just see the significance of this. Now, a lot of this is down to the fact that Nvidia's growth has been just insane. You were talking about over 200%. And in its last update, it suggested that growth coming up further and year to date was looking like only 118%, which is still massive. But when you compare it to what investors had been used to and had been expecting, it's significantly lower. So there's now all this thought that, maybe Nvidia has hurtled up too high, it's become overvalued. Maybe people need to sort of rethink the expectation that this AI boom is going to be just something which coats everything with a veneer of gold. And a lot of other tech stocks, a lot of chip stocks were also hit by this. But we're still talking about it's up 114% over the course of the year to date. So, I think there is concern, there is volatility, but it is still a really good performer.
Now, we're going to cover some really interesting takeover prospects shortly, but let's talk about interest rates first. So as you mentioned, Danni, we had that first rate cut from the Bank of England in August, and we've got the next decision from the Monetary Policy Committee on the 19th of September, where the bank will decide whether to stick or to cut, and if it decides to cut, by how much. So I think it's always useful to look at what markets are pricing in. Now, this is by no means nailed on as to what's going to happen. It's more just the market expectation of what's going to happen. And if we look at that, they are expecting the Bank of England to stick at 5%. And then there's a small chance of a cut to 4.75% in that September decision. And then at the next meeting in November, because there isn't one in October, markets are pricing in a cut to 4.75%, and then a small chance of another cut in December. So that would leave us at 4.5% by the end of this year. But obviously, those projections that are further out are less reliable. A lot can happen between now and then. A lot more data can happen. Markets can move, as we well know, not to rely on these kind of longer term forecasts. What it broadly shows is the direction of movement is cutting, but certainly not in a dramatic way, certainly not expecting big chunky cuts, and not even necessarily expecting consecutive cut after cut, more just a couple before the end of this year. And it's a slightly different story if we look at the European Central Bank, because that's also expected to be on this rate cutting train, but with a drop to 3.5% in September. They've got a meeting next week to decide. And then more cuts are expected in October and December to end the year around 3%. And there's a bit more certainty there of continual cuts at each meeting. Certainly that's what markets think.
Yeah, I mean, rate cuts are something which investors are keeping a really close eye on. And one of the areas which obviously is really hoping to see rate cuts by the Bank of England pick up pace is the house building sector. So we had results out recently from Barratt, which profits were down a whopping 57% to 385 million. But the interesting bit was house building targets. So obviously, the new Labour government has come in, it's put house building front and centre, but Barratt built just over 14,000 homes in the 12 months to the end of June. That's nearly 20% below the 17,206 completed the year before. And there's an expectation, because there's been a lack of land, that next year will look like even fewer homes being completed. Now, the reason I wanted to talk about Barratt is that we're just going to touch on some of the merger and acquisition activity which has been ongoing. And one of the things that Chief Executive David Thomas was talking about in those results was the acquisition of Redrow. So that has now been completed, although it is on ice at the moment because they're working with the Competitions and Markets Authority to finalise the clearance process. But there's also been some really interesting moves with the online property portal Rightmove. So its shares were up significantly at the start of this week, and there's a lot of expectation that the Rupert Murdoch News Corp majority-owned REA Group, which is a big Australian property giant, could look to take over Rightmove, a 4.4 billion takeover of the FTSE 100 company. Now, there's a lot of similarities between these two businesses, and it would effectively mean that the company would be number one in the market in Australia and in the UK as well. So there's a lot of sort of interest into whether or not there will be a formal offer made. REA Group has until the end of September now to make a formal offer. And we've had a lot of movement this year. A lot of companies have drawn attention from foreign investors. I think, when you're talking about a lot of UK listed stocks, they're still looking pretty cheap comparatively to stocks around the rest of the world, particularly in the United States. And was another move this week from property developer Segro, who has agreed the takeover of Tritax Eurobox in an all-share offer. Now, once again, this was really interesting because Tritax has been courted by a number of other companies since June. Brookfield, a Canadian investment firm, said that it had been in the early stages of assessing a possible cash offer for Tritax Euroboss. It's still got to the end of the month to make a firm offer. So Segro shares fell on Wednesday, 2.16%, but they've been up 19% in the last year. And of course, whenever you're talking about acquisitions versus cost cutting, investors get a little bit nervous. But this does seem to be quite a sensible tie-up, quite a sort of harmonious marriage if it does go ahead. But it's just been absolutely fascinating to watch those companies that have become the target of takeover, but also a lot of discussion, speculation about which companies might become takeover targets over the next few months.
And we will keep you updated on all of those as usual. So Nick Train is one of the UK's best-known fund managers, and he runs various funds and investment trusts. Dan Coatsworth recently caught up with Nick to talk about his Finsbury Growth and Income Trust. And we're going to run the interview over a couple of episodes because Nick had a lot to say about big UK stocks and the state of the market at the moment. This time they spoke about Diageo, Rightmove's takeover approach, and the stocks that Nick might be added to his portfolio in time. But to kick things off, Dan asked Nick about his investment in fashion group Burberry, whose shares are languishing at a 14-year low. And also, hot off the press, it has just been kicked out of the FTSE 100 index and relegated to the FTSE 250. So let's hear their chat now.
Do you look at this as if to say, this is an opportunity of lifetime to buy Burberry really cheap, or are you slightly worried that they might have lost their way?
It's a very live question, Dan, and I actually don't know the answer today. I'm hoping that I might be clearer in my mind at sometime over the next 10 days. We have an opportunity to meet with the new chief executive in about 10 days' time. And in my mind, that is an important meeting for us to hear from the new CEO what his vision is for the company and what strengths and weaknesses he sees in the business. What I would say about Burberry, is that this is the second time in the 21st century that Burberry shares have fallen precipitately in a short period of time. So they've fallen a lot, sadly, and it has been a big detractor for us over the last little more than a year, actually. It's about 15 months. Burberry also fell actually about the same percent in 2008, 2009, during the great financial crisis. Burberry shares went from over £7 in 2007 to £1.60 at the low point, I think in late 2008. £7 to £1.60, that is a horrible, horrible decline. But Burberry survived the great financial crisis, and that share price went from £1.60 to a high of £26 last May. In other words, nearly a 16-fold increase. And I think that is indicative of the potential that the business and the share price has today if they can get the brand positioning right in the, from the perspective of consumers. But yeah, one's got to acknowledge that certainly over the last 6 to 9 months, they've not got that right. But is it hopeless? I kind of ask that as a rhetorical question, but we think it's not hopeless. Burberry actually is one of, there's probably no more than a dozen true global luxury or close to luxury brands with scale. And Burberry's definitely one of them. So I'm hoping that this share price fall is a big opportunity. I maybe have a clearer view about that, as I say, in 10 days' time.
I guess on a similar note, perhaps, but not as extreme in terms of share price decline, is Diageo, not particularly doing as well as people thought at the moment, had a few issues in Latin America. As a shareholder, what do you view of the sort of the current situation with that company?
At a conceptual level, the chief executive of Pernod Ricard, one of Diageo's peers, obviously, said at a conference earlier this year, one of the first things that consumers do when they feel more wealthy, one of the first things they do is upgrade the quality of alcohol that they consume. And that's true. You could go back again for decades and see the correlation between growth in consumer confidence and spending power and their consumption of premium alcoholic beverages do indeed begin to subside over the next 18 months, and that is associated with a recovery in consumer confidence. I'm as sure as you can be about anything that Diageo's premium spirits will be beneficiaries of that. But I think more specifically, one's got to look at Diageo's business. To me, you'd absolutely hold Diageo in a UK equity strategy. I mean, it self-evidently is one of the UK's truly significant global businesses. It really does have some fantastic global brands, and I wish there were more companies like Diageo listed on the London stock market. But when you drill down into Diageo, there are three big opportunities for the company, but where it's got clear competitive advantages. Scotch, it's by a very considerable margin the biggest Scotch distiller on the planet. Tequila, where it's the biggest tequila producer in the world with the biggest and best brands. And don't underestimate this, Guinness. Guinness is 16 or 17% of Diageo's business, and that is an important and growing global brand. You add those three together, and you've probably got 50% of Diageo's business, which has a structural growth opportunity ahead of it. You ask about Burberry, and I said to you candidly, I need a bit more conviction. Let's hope we get it. But with Diageo, I think, I think it's much more evident that this should be an opportunity.
So, I mean, obviously, those names have been in your portfolio for quite some time, but one new name, relatively new name, is Rightmove. I mean, your timing is absolutely brilliant. You seem to have bought it, and then only a few months later, it's now subject to takeover interest. Was that the takeover potential? Was that part of your initial potential upside when you were considering the stock? You thought, okay, at this level, depressed by worries about the state of the UK property market short term and competitive threats. Do you think it was inevitable someone might come along and sniff at thinking, okay, maybe I want to be buying this company outright?
No to conceiving that there could be bid interest. That was not in our thinking at all. I mean, it's 12 months ago that we started accumulating. I might just say in passing that this is typical of what we do, and this can be good or bad. I don't know, but we bought a lot of Rightmove. It's a 5% plus holding for us, and that means we've bought. Well, I think we're the second biggest shareholder in Rightmove within a year of having started accumulating it. No, I mean the rationale for investing in Rightmove, which I think remains valid, by the way, is that first of all, and forgive me for sounding cliched or sort of hyping up the idea, but 15 months ago, 18 months ago, we were looking for artificial intelligence type plays within the UK stock market. And it seems to us that companies that are likely to be beneficiaries of the commercialization of artificial intelligence will be companies with substantial amounts of proprietary data. Yeah. If a company owns data and no one else owns that data, and it can use AI to derive information or insights from that data, that's a very, very interesting proposition. And I think everybody would understand why Rightmove has more data on the UK residential property market than any other company. And we saw that as potentially an undervalued asset or perspective on Rightmove. You're correct, that coincided with Rightmove share price having gone sideways for 5 years, the rise in interest rates having dampened sentiment about the UK property market. Yes, we were presented with an opportunity to start accumulating.
If we do get a situation where it is taken over, and it's clearly is a big holding in your portfolio, that would leave you with money, if it's a cash deal to reinvest, and equally if anything else in your portfolio gets taken over. Are you in a position now to be able to know already what where you might want to invest if you had this situation? Do you have like a long list of potential things you want to buy, or would you put it all into existing holdings and just own more of them?
Well, that's always the way we think about running money. That would always be the first question if we receive cash: is what existing assets do we have that are undervalued and where we've got scope to buy more? That would be the first thing I would always add. I've always worked by that Warren Buffett principle that probably the best stock to buy is more of what you already own, assuming that what you already own you own for good reasons. For instance, I would love to buy more relics if we could. But probably we can't because it's close to being our biggest holding. But I'm just saying, the first thing I would say is we own some truly world-class businesses in this portfolio. Diageo, I mean, if we could buy more Diageo, I would. We can't at the moment because of the size of the holding. But it's a fair question. And I wouldn't say there was a long list, but I would say that there is a credible short list, maybe of 4 to 5 UK listed companies that we could and would be very, very happy to own. I won't say that I'd be happy to own all of them at today's price. Some of them have done really well over the last couple of months, but there are definitely ideas that we could access. And without being a tease, and I'm definitely not going to name any names, I would say that that work that we did that got us to investing in Rightmove, looking at London companies with proprietary data, that's a rich seam. Actually, there are other opportunities in the UK stock market of data-rich companies, some of which we own, some of which we don't own. The ones we don't own, we could own them.
That was Nick Train from Finsbury Growth and Income Trust. We'll have the second part of the interview with Nick next week, where he talks about markets more generally, and we get his thoughts on Unilever. Okay, we were talking about rate prospects earlier. Now, a cut in rates generally leads to lower interest rates in our savings accounts, less competition, but it seems banks are also being less competitive when it comes to trying to tempt us to switch our current account, Laura.
Yes, so we've definitely seen fewer options when it comes to those current account switching deals. Now, just to recap for those who aren't aware, this is where banks will offer you a juicy incentive to switch your current account to them. And usually it comes in the form of cold hard cash. Sometimes it can be offers of, subscriptions to things, or sometimes it can be things like free cinema tickets or things like that. But generally, it's cash and decent amounts of cash, actually. So this summer, we had a real sweet spot for these current account switches, with lots of banks offering things like £150, sometimes even £175 to incentivize customers to switch. But according to Money Facts, a lot of these offers have now been pulled. So in the past few weeks, Barclays, Co-op, First Direct and Lloyds have all pulled their offers. But that doesn't mean that they're gone for good. These things kind of tend to work in waves where there will be a bunch of offers and then providers will get enough new customers so they don't need to offer that incentive. They'll pull the offers and then some more might come out. So definitely, if you haven't taken advantage of them, then keep an eye out for options as they come and go. But the top and actually only option right now, according to Money Saving Expert, is TSB. So this will give you £100 upfront, and then you can get £15 a month in cashback for 6 months. So that's a pretty good deal, and that's a decent amount of money. It does have a bit more criteria than some of the ones, some of the simpler ones that we have had previously. So you'll need to spend on your card 5 times in the first month to get that upfront £100. And then you'll need to spend 20 times in each of the first 6 months to get that £15 a month cashback. But if you carry on spending on that card and then you make 20 debit card payments in March 2025, so quite far in the future, you will actually get an extra reward. So you can choose from a number of things like 6 Odeon cinema tickets or a 6-month Now entertainment membership, that streaming service. So that is the only option out there right now if you wanted that current account incentive, but also definitely keep an eye out for them because I'm sure they will be back.
And I can imagine that people might need a few extra pennies to cover increases in fuel bills this autumn. We've, of course, had an increase in the energy price cap, which comes in October. And millions of pensioners have been told their winter fuel payments will stop. But there has been a bit of good news for pensioners in that we're pretty sure what the state pension is going to go up by in April next year, Laura.
Yeah, so the state pension increases each year by the triple lock, which lots of people will be aware of, but for those that aren't, I will recap. So this means that state pension will rise by the highest of either the average earnings growth, inflation, or 2.5%. And what we look at are specific months of figures for those. And so we've seen lower inflation this year, and so it means that it's likely that average earnings growth is going to be the figure that we use to increase that state pension by. We use the figures from July for reasons unknown to me, but that the government has decided on. And those figures are published on the 10th of September. So as we're recording, that's next week. And so when that figure comes out, it's likely that reading will be used to determine what the state pension increases by. Earnings growth of 4.5% was seen in April to June. So if that's repeated in May to July, and also inflation remains low, then that means that we'll get a pretty meaty increase to the state pension from April next year. So if we think about the new state pension, that means that it will increase from £221.20 a week that it is at the moment, up to £231.15 a week, or more broadly, up to just over £12,000 a year. So that's about a £500 increase per year for that state pension. But obviously lots of people will have seen that winter fuel payment drop, and so it might help to counteract some of that. But yes, lots to look out for.
Now, we've done a few pension webinars recently, or I should say you have, and had a couple of questions that we didn't get around to answering at the time. So here we go, Rachel. We've got 3 for you, starting with this one. This is from John. I'm 72. I'm aware that if I die after my 75th birthday, my pension pot would be taxed as an income on my beneficiaries, wife and children. This would incur some sort of 40% liability. So would it make more sense to withdraw from the SIP now and pay only 20% tax on this and then use ISAs to live off?
Well, this is it's an interesting question, Danni, and it's one that we get a lot. So people want to know how best to use their pension investments and their other investments going forward. I'll start by just saying that most people have a variety of assets when they die. They've got property, they've got pensions, they've got ISAs, other investments. So it's really when they enter retirement, they've got to decide which ones they're going to spend now and which ones they would like to pass over to their loved ones when they die. So when you're doing that, you need to consider both the tax you're paying in your lifetime, for example, capital gains tax or income tax, and also think about inheritance tax. Now, pensions are a really tax-efficient way of passing on wealth when you die. And this is because there is incredibly generous tax treatment at the moment. So if you die before 75, then if you pass your pension pot onto your loved ones through drawdown through income, then there are no limits. You can pass as much money as you want onto your loved ones, and there's no tax that they pay. It's all tax-free. So in my dreams, I could have a £7 million pot, and then I could pass that on to my loved ones, my family, and they wouldn't, if I died before 75, they wouldn't pay any income tax or any tax on that at all. If you die after age 75, then the pension funds, which you pass on to your beneficiaries, when they take them, either as an income or as a lump sum, they will pay income tax on that. But they could do it through drawdown, and that helps mitigate the amount of tax that you take. So that's the income tax, but you also need to think about inheritance tax. Now, pensions are free from inheritance tax, so they don't fall into anyone's estate when they die. But other investments like ISAs or equities or stocks and shares or whatever you happen to have, that does form part of the estate. So for that reason, it makes sense for people to spend their ISAs first in retirement because they're running down a fund that will go into their estate. So, and then leave the pension money alone because it won't count towards the estate for inheritance tax. But the answer with this, with loads of things in pensions and savings, is it really just depends on people's personal circumstances. So you've got to think about how much money someone is paying now, how much tax they're paying, how much income do they need to take out from their investments to meet their needs. Are they going to spend all of that money, or is it going to sit in their estate? There's no point taking money out of a pension if it's just going to sit within your estate or your bank account. Can they give the money to someone else during their lifetime? There's loads of rules around what you can give under inheritance tax rules. And there is what tax would their beneficiaries pay on any income if they took it after the person died. To really summarise it, not touching the pension money up to age 75 makes really good sense because, as I said before, it's in a really tax efficient place. And then when maybe someone gets to age 75, they need to review the situation, taking all of their personal circumstances into account, and then to figure out what the best option is for them.
Lovely. Thank you for that. That's super helpful. So let's go on to our next question. This one's from Ashcock. I have a large SIP. I also have 4 other pensions that are currently valued between £4,000 and £25,000. I was thinking of using the small pension pot allowance to cash in some of those pensions, but I'm not sure about the rules as I want to carry on contributing to my main SIP. So, Rachel, we should probably start with what these small pension pot allowances are, maybe.
Yes, I do love it when people put in these sort of like very weird terminology of pensions. It's sort of like makes my heart rise. So a small pot means that you can take a small pension pot of £30,000 or less. And if you take all of the benefit as one, so you could take the tax-free cash out and then put it into drawdown, or take drawdown, or take it as a tax lump sum. But if you take that whole £30,000 pot, then it doesn't count towards those 2 big limits that we now have in pensions. Now, those pension limits are your lump sum allowance. This is just a reminder, your lump sum allowance, which is the amount of tax-free lump sums you can take during your lifetime, say from tax-free cash or something like that. And that's £268,275. You've also got this other allowance, which is your lump sum and death benefit allowance. And that controls the number of tax-free lump sums you can get in both in your lifetime, but also the tax-free lump sums that you pass on death. So that is a set at 1,073,100. Neither of those are easy sums or easy.
Why don't they just round them up?
Why not? So, yeah, absolutely. But if you use the small pot allowance, what it means that is if you are really close to those limits on your other big SIP, then if you use those small allowances, you can take these little £30,000 pots and they don't affect those limits. They're not counted. So you sort of like, you can just use those. Now, that sounds really good. If you're looking at a defined contribution world, then you only get a personal pension world. You only get 3 of those. So you can only use it for 3. You couldn't use it for 4 of those small pots, only 3 of those small pots. But it does mean some allowances. The other thing to be really aware of is that if you want to access your pension and get hold of your pension money, but you also want to carry on contributing, then you need to be really, really careful. You can, no, I know this is a podcast and only audio, but I am now putting up my fingers for inverted commas here, because if you flexibly access your money, which is such a horrible phrase, but if you flexibly access your money, then in a pension, then the amount you can carry on contributing comes crashing down from £60,000 a year to £10,000 a year. You really don't want to do that, because that's called triggering the money purchase annual allowance, the MPAA. But there are ways around this. You can get hold of some of your money out of your pension without triggering the MPAA and just looking at 10,000. You could take your tax-free cash, but then just leave the rest in drawdown. So if you don't take that flexible income, your annual allowance will stay up at £60,000. You could take your tax-free cash and buy an annuity. Now, that's a guaranteed income for life, but it is quite restrictive, and it really depends on your personal circumstances whether an annuity is the right thing for you. But I think the bottom line with this one is that if you want to carry on contributing more than £10,000 a year, you need to be really careful when you're looking at what money you're going to access and how you're going to access it. So just double check with your provider if necessary, or a regulated financial advisor, but just be careful.
Oh, it's so complicated, Rachel. Okay, let's end with this one from Katsuku. I've taken my lump sum from my pension, but left that in my dealing account and the remainder untouched in pensions drawdown. The last government removed the lifetime allowance, but the Labour government may introduce further changes in the LTA. What would be the best way of dealing with the uncertainty? I bet this is something you're getting asked about a lot.
So much. And it's really difficult, because it's really difficult financial times for the UK. And it does feel like there's this cloud of uncertainty hanging over us all, especially when we have our Prime Minister telling us that we're going to have a very painful budget. So there is no shock that everyone is worried about how the government could change the pension rules and whether they will get caught short and what it would mean for them. So I really empathise with Katsuko about this. However, it's really difficult to second guess what a government's going to do. And the decisions that you make about your pension money should be based on what money you need and when you need it. If you don't need that income or the cash at the moment, then you could leave it untouched. And certainly the drawdown pot will continue to grow in a tax advantage environment. But if you do need the money, there's no point just leaving it there. You take the money and access the money. One of the things to bear in mind is that when we have had big changes to pensions, when they first introduced the lifetime allowance, all those years back in 2006, and when they have dropped the lifetime allowance, then the governments have brought in transitional protection, which means that you get to, if you've built up a certain amount, you get to keep that amount. So any change that came in for lifetime allowance, I would imagine will come with a big suite of protections. And so you shouldn't really lose out. None of us can really shelter our money when we don't know what's going to happen. And unfortunately, I haven't got a crystal ball. I really don't know if the lifetime allowance would come back and in what format. And there's so many rumours going around on this. I think ultimately, though, you just do what the best decision is for both you and your family. Don't try and second guess it. Think about your position. And if changes are made, then hopefully the transitional protections will be in there to work for you.
Thank you, Rachel. Loads of really useful information there. And you should just say that Pension Awareness Week is next week. So we'll have loads of material up on the AJ Bell website. Okay, that is it for this episode. Next week, Dan and Charlene will be in the hot seat, and we'll have part 2 of Dan's chat with Nick Train, plus he's been catching up with Stuart Widdowson from Odyssean.
Don't forget, if there's anything you think we should be covering or anyone you'd love to hear us chat to, then get in touch and we will do our best. You can email us at podcast@ajbell.co.uk. Until next time, thanks for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.